This conference will now be recorded.
Okay, it's now 10 o'clock in the morning. Good morning, and thank you for joining us. I am Zachary Taylor, one of First Northern Credit Union's business development representatives. We have our mortgage loan officer, Lindsey Swanson, with us this morning to present today's Guide to Home Buying webinar. This presentation is a part of our financial wellness series. Due to the current social distancing practices, we are presenting this one as an online webinar for the time being. We will follow up with an email in the following week that has a recording of today's webinar along with the materials that will be presented today. Just a quick note that we do have many other free financial wellness workshops that we are hosting as webinars right now. And for more information and to view these upcoming webinars, please visit www.fncu.org/seminars. Today, Lindsey will share information and tips to aid in the home buying process. Whether you're a first-time home buyer or not, Lindsey will go over pertinent information to think about before and during the process. Throughout the webinar, if you have any questions, please ask them in the chat box to the right, and Lindsey will address them after her presentation. I will also place Lindsey's contact information in that same chat box to the right in case you have any further questions. And with that, I will now turn over the microphone to Miss Lindsey Swanson. Go ahead and take it away, Lindsey.
Thank you, Zach, and good morning, everyone. Thank you for joining us on Guide to Home Buying. Sorry, my computer is being a little delayed. There you go. So why buy a home? You can have a pride of ownership. There's tax deductions, a stable housing cost, gain equity, and you control your property. Some myths about home buying is everybody thinks that they have to put 20% down or if they need excellent credit and you can only get a 30-year mortgage. We will go through some of those here shortly. Are you ready to buy? So what we like to see is steady and consistent income. We like to see that you pay your bills on time. You have low to medium debt. Your down payment is available to you. And you have the ability to pay a mortgage and reserves are available if they're ever needed. Planning ahead. In order to get a mortgage, I always tell my borrowers to go ahead and plan ahead and pull one of their annual credit reports online. Now, this won't basically give you always the score that we need, but it kind of shows you things like if you have any collections on your account, what your monthly debts are, or kind of like a range of any other fees such as credit card payments or anything like that. You want to know how much able to do for down payment and closing costs. And then you're going to choose a team of realtors, attorneys, etc. You're going to get pre-approved and determine what you're comfortable paying for a monthly payment. Credit scoring and overview. So there's a number of summaries of your credit risk. The higher the score, the lower the risk. The account payment history amount of time accounts are open, and the credit inquiries. FICO credit scores, they usually fall between 300 to 850, and it indicates the probabilities of 90 days late on any accounts within the last 24 months. There are 3 credit bureau companies, and in those credit bureau companies, there's Experian, Equifax, and TransUnion. So what the credit bureaus talk about or record on, hold on. Sorry, my computer's slow. So the components of the credit bureaus. So they're going to look at your payment history. 35% of your score is based on that. 30% is about the amounts owed. So when you have a credit card, for example, has a $1,000 limit, they like to see the usage basically below 30% when it records. So if you have a $1,000 limit, you want to keep the amount charged of less than $300 when it is recorded to your credit bureau. So usually they record it to the credit bureau about the same time they send out your statement. So everybody sometimes comes in and saying, well, I pay it off every month. Well, when you pay it off is after you receive your statement, but it's recording on your credit report as that maxed out amount or that amount during that time. They like to see length of credit history. So don't go off closing all those credit cards that you may have opened at younger age. Obviously, if you're paying fees for them, you're going to want to talk to them, but they want to see a long credit history. So try to keep those old credit cards still open. The type of credits that you use. So they don't like to see like a whole lot of Express, the Buckle, Menards. They don't like to see a whole lot of store credit cards. They don't want to see a whole lot of major credit cards, but they like to see all different types of credit. They like to see installment loans. They like to see revolving credit cards like your Visa, MasterCard, and then they obviously like to see like your store credit cards. New credit. So they don't want to see basically you going out to opening a lot of new cards. So when you open new cards, you're lengthening your credit history or you're shortening it. So try to stick with just a few credit cards that you use. Your credit score implications are your maximum loan to value. It helps you with your interest rate and what are mortgage programs which you would qualify for. How to improve your score. Pay your bills on time. Keep the balances below 50% of your available limit and below 30% if possible. Do not close your unused accounts. The zero balance can help your score. Pay off recent collection items or charge-offs. Let old items over 2 years remain unpaid. So if you pull your credit and you see that there is a $10 $10 collection from your doctor that's been on there for 5 years, your natural instinct is going to go and pay it off, but actually you don't want to do that because usually after a period of time, it's no longer recording negatively. It's recording, just not maybe as negative, and if you go to pay that, it would actually reopen it as a new recording. So if you do want to pay off that $10 doctor bill, I always suggest to people to call the creditor, say, hey, I would love to pay that off today, but can you please delete this from my credit report? Deleting it is going to completely remove it from there. Same things if you have like a recent payment on a Target card that you may have missed on accident. Give them a call, ask them if they'll delete it from your credit history. They don't always do that, but they may do it. There are credit repair services. Nobody has a magic wand that erases your bad credit legally. You can submit disputes to the credit bureaus. The credit bureaus must respond to you within 30 days. If a bureau cannot verify the negative information, it must be removed. Legitimate credit repair agencies may assist you in removing negative items, but be also careful that some credit repair places aren't technically legitimate, so make sure you do your research on who you use for those. Choosing your team. You're going to want to choose a mortgage lender, a realtor, a home inspector, a lawyer, and an insurance agent. What types of homes? So you're going to want to look at type of community, if you want a new home, a resale home, a fixer-upper, and things that are important to you, such as number of bathrooms, bedrooms, garage, yard, anything like that. If you want a condo, if you want to live in an HOA, you want to research those kind of items. How much can you afford? So housing costs of less than 29% of your gross income, and we like to see housing costs no more, plus your debt, no more than 45% of your gross income. Consider special loan programs. So if you make $10,000 a month before taxes, you would not want a payment of more than $2,900 for your mortgage payment and no more than $4,500 in complete debt in order to qualify. Now, this all kind of depends on what your credit score is, what your other debts are, stuff like that, but that's basically the foundation. Monthly components. So we're going to base your payment on your principal and interest, the length of a loan. Your taxes and insurance will always take 1/12 of those costs. Any additional costs, such as HOA fees, PUD fees, if you live in like a mortgage insurance. Our pre-qualification. A pre-qualification is easy. It provides you with a rough estimate of how much you might be able to borrow. Carries little weight since lenders are not committed to underwrite your loan. Not recognized by a home seller as a plus in the offer. And it would consider as a negative relative to others that which have a pre-approval. It does not typically include an analysis of your credit report or an in-depth look at your true ability to purchase a home. So when you go online and you do a pre-qualification, basically it gives that lender the ability to pull your credit, but basically you can tell them, hey, I make $10,000 a month, but they're not going to verify it with your pay stubs or W-2s or anything like that. Here at First Northern, we actually do pre-approvals. We go one step further than their pre-qualification. So we're going to pull your credit. We're going to take in your documentation, such as your W-2s, your pay stubs, your tax returns, your bank statements, and everything like that, any kind of Social Security income you receive, and we're going to take it, we're going to plug it into a desktop underwriting system, and we're going to run it, and that will give us basically an approval or a denial. So then once we do submit the pre-approval, it's basically been pre-underwritten by us and the desktop underwriting system that we have verified all of your income. So when you submit that to your offer, a seller is more likely going to take your pre-approval because they know that you've gone through the whole process versus a pre-qualification of just giving your Social Security number and what you think you make for a monthly income. Why it is important to get it pre-approved so then you know what you can afford. It shows realtors and sellers you're actually a serious buyer, and you can make an offer as soon as you find a home that you want to buy. Our pre-approval process is we take the application over the phone or online. Our loan officers will ask you questions. We'll pull your credit. We'll run it through that desktop underwriting system and find out which programs you may qualify for. At that time, we will discuss rates, closing costs, down payment, or any other information that you may have questions about. And then we'll also ask you to provide us with that supporting documentation of your income and assets. Here again is another list of items that we would use for pre-approval: pay stubs, tax returns, recent bank statements, retirement, investment statements, proof of any other additional income, student loan payments if they're in deferment. If you have recently been divorced, we'll ask for divorce decrees, anything like that. Bankruptcy documentation if you may have that. Qualification factors. So we're going to take your income. We're going to look at your regular pay, your overtime pay, your bonus pay, second job, retirement, Social Security, and investments. So each type of payment requires different amounts of time. For example, if you work a job and you're paid a flat $20 an hour and you've worked that job for 2 years, obviously we're going to use that income. Now, if you're self-employed, there's different rules and regulations, same with overtime and bonuses. So that's why we're going to ask for a 2-year history on those items to make sure we factor in at the correct amount. Qualification factors. So your debts are going to be considered as your car loans, your student loans, and your credit cards. So your car loan, if it's $500 a month, will count as $500 a month. Student loans now. So many people have student loans, but they may be deferred, so you don't have to make a payment on them. But technically, we have to still hit you with a payment, depending on which program we use, of either 1% or 0.5%. So it depends on what kind of program we use, but we're going to look at that. We can use other documentation such as your income-based plans. We can use those. Assets, we're going to look for down payments, amounts that are going to go towards the down payment, reserves, and your access to a gift. Many borrowers receive gifts from family members, and we can use those as long as they're documented correctly. What not to do. So once you get pre-approved, you do not want to go open a new credit card. You don't want to buy a new car without talking to your loan officer. You do not want to change your job. You want to make sure you keep making all payments on time, and you keep as much money still in your bank account as we discussed. So a lot of people, I tell them, still pay all your bills, but make sure that you still keep as much money as possible in your bank account. What program is best for you? Do you expect your finances to change? Are you planning to live in the home for a long time? Are you comfortable with your payment fluctuating? Do you want to have your mortgage paid off by a certain time? And how much will I have for a down payment and closing costs? Those are all questions we will go over with you during your pre-approval process. Down payment and closing costs. Savings must be documented. You cannot borrow funds unless a loan is secured and payment is disclosed. Gift funds are typically accepted, however, requirements vary from program to program. So again, you want to talk to your loan officer before receiving a gift from a family member to make sure that we are able to use that gift and what kind of documentation we may need. There are no down payment programs available by the state and community programs, bond programs, and qualified veterans. Home buying assistance. There are federal, state, and local programs that will provide financial assistance to first-time homebuyers. And currently we are doing a program that you don't even have to be a first-time homebuyer. You can be a second-time homebuyer, but you have to qualify within the income limits. The assistance can include down payment assistance, closing costs, or interest rate buy-down. The types of loan programs, there's conventional, there's FHA, there's VA, a USDA loan, and first-time homebuyer program. A conventional loan, you can require a down payment anywhere between 3 to 5%. It must have a stronger credit history. It has a lower PMI, and gifts are allowed for the down payment and closing cost. An FHA loan requires 3.5% down payment. It's a little more lenient on credit. It does have a higher PMI, which is mortgage insurance, and you're going to pay that upfront and monthly. And most FHA loans carry the PMI for the life of the loan, and gifts are allowed for down payment and closing costs. But with an FHA loan, you're going to want to be careful, because if you receive a gift from grandma for $5,000 or even $500, they are going to require us to get a bank statement from grandma to show she actually had the ability to give that money to you. So when receiving a gift for FHA, it gets very hard, because most people don't want to give up their bank statement to show somebody else how much money they have in their checking account. So I would definitely talk to your loan officer before receiving a gift from any family member to make sure that you can actually still use it. VA loans. VA loans are used for qualified veterans. They require no down payment. They're more lenient on credit history, and they have no more monthly mortgage insurance. A USDA loan is 100% financing. There's no PMI. It's only available in certain areas of the counties, and it's not intended for financing farms. So if you find a 50-acre farm with a little home, that's not what it's used for. It's used for just basically purchasing a house in a rural area. First-time buyer loans, we use Illinois Housing Development Authority's IDA, but currently the programs they have available are actually available for even second-time or currently owning a home. You can use these loans for either a conventional FHA, VA, or USDA program. They offer down payment / closing cost assistance. The borrower must contribute 1% or $1,000, whatever is greater, into the transaction. So if you buy a house for $150,000, you're required to either put in $1,500 into the transaction. And there are minimum credit scores and debt to income limits. What is PMI? PMI is private mortgage insurance that is provided by the lender, which is an insurance if you were to default on the loan. This is required when the mortgage amount is higher than 80% of the home's value. PMI is a tax deductible. You can talk to your accountant about that. So if you purchase a home for $100,000 and you put 5% down, you have a loan to value of 95%. If you were to put $20,000 down, then your home would be at a loan to value of 80% and would not require the private mortgage insurance. Questions to ask when shopping for a home loan is you're going to want to ask the interest rate and the APR. So if you do notice that an interest rate is like, let's say 2.5%, but you see that the APR is 3.5, you know that you're going to be paying some type of fee for that interest rate. You're going to want to talk to your lender about purchasing discount points, origination fees, what the closing costs are, how long it will take for the process for the mortgage, is there a prepayment penalty, is there an application fee, do you offer rate locks, and if so, how long, and do you charge for those fees? Here at First Northern, we do not charge for an application fee. We have no prepayment penalty on most loans. And then when we do lock you, we do not charge a fee up front to do that. How your realtor can help you. So your realtor is going to take you to show you the properties and set up times for you to view them, to get to know the community and guide you through the process. Determining the offer. What are the comparable homes selling for? What is the home's condition? And you're going to rely on your realtor for guidance and help you prepare to negotiate a contract with the seller. Once you find a home that you like, you will write a contract and you will give the seller what they call earnest money. It's usually between 1% to 5% of the purchase price. If the offer is accepted, you give them the earnest money and it'll be credited back to you at closing. If the offer is rejected or something happens with your inspection, the money is returned to you. And when you do your earnest money, your lender does not want to see you Venmo the money to them or you PayPal money. You want to either make it a cashier's check from your checking account or write them a personal check. We do not like cash or anybody else to write you the check for you. It needs to actually come from your account and be able to be seen. There is an attorney review period. So if you choose to hire an attorney, they were going to go over and look over the contract with you along with the property disclosures. They're going to look at the property's title to ensure that there's no problems or issues, and then negotiate and resolve any inspection items for you. You can choose to have a home inspection. Basically, this contract can be contingent on inspection for your home. You're going to have a professional inspector evaluate the safety and the condition of the home, which includes the structure, construction, and mechanicals of systems of the home. An appraisal is going to be ordered by your lender after the purchase agreement has been completed. Appraiser will actually physically go into the home to document items such as the number of bedrooms, bathrooms, locations, and dimensions. It will review the information and arrive at a final estimation of value based on the comparisons of the homes. So if you're purchasing a home in a neighborhood, it's going to use comparable homes to make sure that the value is there, which you are purchasing the home for. Closing costs. Well, within the closing costs, there is going to be a loan origination fee, any third-party fees that might have to be done, such as an appraisal, credit report, flood search. You're going to have title fees, which is going to be a closing fee, a lender title policy, and endorsements. This is basically going to make sure that the property you're purchasing is free of any other liens besides whoever your mortgage provider is going to be. You're going to have prepaid items such as interest and then recording items. And then you have an escrow account, which is going to include your taxes and insurance and PMI if you have the less than 80% loan to value. On closing day, you will go to usually your title company, and your closing agent will detail transactions of closing disclosures. You will present a check for your down payment / closing costs. The seller will provide you proof of any warranties or inspections, and the deed will then be recorded with the title company. And then you are a homeowner. If you have any questions, let me know. We are available anytime through the phone or email. Please reach out. Even if you're purchasing or refinancing a home, we're here to help you. Thank you.
Thank you so much for that, Lindsay. That was very informative. We do have some questions that did come in through the presentation. I'd like to take a bit of time now just to go through those. So let's jump right into it. Question number 1, is PMI something that someone should aim to not have by putting down 20%, I believe you said?
So PMI, I mean, everybody wants to have the lowest monthly payment as possible. It's not always a bad thing. You can, PMI is based on like your debt to income, your credit score, stuff like that. So sometimes it's even cheaper just to have PMI versus bring in the 20%. This is all on a situation-based determination. But obviously everyone's goal is not to have PMI because they would like to have more equity in the home and not pay that monthly fee. With PMI though, there are different ways you can pay it. Sometimes most people pay it monthly. I've had people pay it up front. I've had people roll it in. I've had people up their interest rate so they don't have to pay it. So it's something I would definitely talk to your mortgage lender with and the different options that you can look into.
Perfect. Thank you. Okay, next question is, during the pre-approval process, when credit is pulled, is that considered a hard inquiry on the credit report?
Those are considered hard inquiries. Your credit is good for 120 days. So if you pull your credit on day 1, you have to close the loan within 120 days. The credit bureaus do understand that, like when you're purchasing a car, you're going to be out shopping for rates. So usually within the first 30 days, you won't see too much of a hit once you have a mortgage lender hit it. But we just not suggest to, have it keep hitting it and keep hitting it and keep hitting it. And it does pull all 3 bureaus. So whenever you apply for a mortgage, it will pull all 3 of them. Versus if you go get a car loan, most of the time they only pull 1, maybe 2.
Okay, perfect. Thank you for that. That actually answered another question on there, which was how long the pre-approval letter was good for, and you said up to 120 days, correct?
Your pre-approval is good for 120 days. I only write my pre-approvals for 90 days. That being is because I don't want to write a pre-approval and then have to go re-pull someone's credit and find out something as little as a $10 collection had hit and now you do no longer qualify. So I actually write my pre-approvals for only 90 days, but your credit is good for 120 days. The reason why we do that is then hopefully we'll get your pre-approval, you get your contract, and we'll know we'll close before we have to re-pull your credit again.
That makes sense. All right. The next question was, let me see here. So does the buyer find the title company, or is that something that we do through mortgage, through the credit union?
So when you're purchasing a home, technically you can choose who you want to choose for a title company, but the seller usually does pick the title company. And I usually tell people, unless your best friend or your brother owns a title company, it might be cheaper to just go with who the seller picks, because now if you pick a new title company, they're going to have to do some of the same work that the other title company is doing, and they might actually end up charging you more. Now, when we do a refinance, we have some that we work with. So, but if you do choose one that you would like, we can still choose them.
Okay, perfect. Okay, let's jump down to this question here. What's your opinion on using online tools such as Zillow in regards to checking prices, things like that? Can those values be trusted, or should they just come directly and ask?
I would talk to a realtor about that. They're going to want to be the ones who look at home values. In the past, basically what Zillow does is if you look like, for example, on my street, they take how many houses there are, what they sell for, and they divide by that how many houses. So it doesn't matter if you have a 2-story or 1-story, they just automatically just divide back then. Now that was,
Gotcha.
an old way of doing it, so I would definitely contact a realtor, but we will always order an appraisal to make sure that the value is there.
Okay, fantastic. And that leads us actually into the final question that I have on here. Do you have to be an agent to access the MLS?
No, if you can access the MLS, I believe, like where we are in Rockford, you can go to www.raar.com. You can look at the listings, but obviously if you want to go see them, you would probably need a realtor in order to contact the sellers to come in, or you would contact the listing agent in order to view those homes.
Okay. There was one final question that just came in off of that. As far as signing a contract with a real estate agent, do buyers have to do that, or is that just something for the sellers?
So that could be looked either way. If you go to an open house and you sign in, because usually they want whoever's selling the house, they want you to sign in. It could be that you already viewed it with who may be using the open house. But in regards to an agent, I mean, if you have your own agent, they can't really stop you from going to open houses. So I would definitely reach out to an agent in regards to those questions.
Okay, perfect. Thank you so much. That is all the questions that we had come in during that. Again, I have posted Lindsey's contact information in this same chat box. If you have any further questions that you think of later on, don't be afraid to reach out to her. That is her phone on there. Email, is there a preference that you would like them to reach out to you, Lindsey?
No, phone or email works for me. We try to return phone calls and emails within 24 hours.
Okay, perfect. With that, thank you all so much for joining us. I hope you have a wonderful rest of the weekend. And as we said throughout there, if you need anything or have any questions, reach out to any of us. So Lindsey is going to be your go-to for any mortgage stuff on there. If you just have general questions about First Northern, all my contact information was on the email that you got for registration. With that, have a wonderful day, stay safe, and thank you all so much.
Thank you, Zach. Have a great one.